Hello, this is Cynthia Fick, and this is the March 7th stock market update. Hope you guys are doing well. There's a lot going on as usual, and I'm going to try to focus on three major things. First one being that the Federal Reserve Board president came out this morning. Basically, Jerome Powell is saying that inflation has been harder to beat down than he expected in the past, and that there's a chance they may be raising interest rates a little bit more than they expected over the next several meetings. And so we have a meeting coming up in next week, and it looks like they may do 50 basis point increase on the Fed funds rate in March. And then there's another meeting in May, and they may do the same there, depending on a lot of numbers, which we have coming out. There's a jobs number on Friday, and then there's the CPI number next week. So it's going to be interesting. So they're talking about raising interest rates to, again, vanquish this thing called inflation. And the stock market in the beginning was handling it pretty well. So let's look and see what is going on with stock market. I'm going to share a chart here with you really quick. So again, I said after the big move we had in the market, not surprising that we'd have a touchback. And the market is touching back to that 150-day moving average, even with the news today about rates going up, is still hanging there and doing okay. So that's what's happening in the stock market. Let's talk about what happens with the bond market. So interest rates have just tripled over the last year or so. So we've seen that in their attempt to slow down the economy and kind of vanquish inflation. So that's why they have gone up. Interest rates have gone up, bond prices have gone down. So we know in our money markets, a lot of them are paying over 4%, and that's been fantastic. But again, those rates aren't locked in. So some of us have talked about maybe we should do a CD, or maybe we should do a bond. Let's talk about bonds a little bit. It's like, consider it something like this. You're buying a cow. Okay. It's not a stock. You're buying a cow. And so interest rates, that those cows are giving a lot more milk right now, which is your interest rate. You're getting more interest, more milk from your cow. When we go in and buy individual bonds or individual cows, we're buying them for a certain period of time. We're locking money up for, say, 7 years, 10 years, and we're getting a certain rate of return, a certain interest rate. So if we buy a cow for $100, we get our milk, we get our 6% or so from a corporate bond right now every year. And at the end of the time frame, we get our money back. We get our $100 back, and we've been getting the interest. But what happens to that cow and the price of beef during that time frame? It can change. If interest rates continue to go up, we may see the price of our cow, which we paid $100 for, it might go down a little bit. And so we may see some fluctuation. But again, I'm going to challenge you right now. It's a good idea to lock in some of these interest rates. They've just tripled. So why not lock some of them in? In the meantime, you're going to see your cow, the price of beef is going to go up and down. And that's okay, because you've got a good income source coming in through the locked in interest rate and the milk that cow is giving you. So try your best as interest rates kind of fluctuate in here to ignore the price of beef, focus on the wonderful milk that you're receiving, which is the interest and the higher rate that you locked in. And in the long run, things will resolve, things will work itself out. So that's just an analogy I like to use to help people understand more about how a bond really works. And that's why we're buying individual bonds and not bond mutual funds. So hope you guys have a great week, and we'll be talking to you next Tuesday. Have a good one. Bye-bye.